Welcome to Smart Real Estate. I'm Addy Saeed, and this is the show where we translate what's happening in Canadian economics and Ontario real estate into something we can actually use as an investor. Solo episode today. A lot happening this week. The April CPI numbers dropped and confirmed what two of Canada's top economists have been forecasting. The Bank of Canada is on hold, and rates are going to be moving this year. I want to talk about what that actually means for you and your underwriting, because some investors are still building in rate relief that isn't coming. We also got a Montreal family office making $500 million bet on Toronto Condo Glut, a Parkdale building that sold in the middle of an active rent strike, and what the buyers inherited: a brand new regulatory compliance requirement launching in 22 days that every Toronto landlord needs to know about, and a highway that just repriced the rental corridor. Before we get into it, if you're not on LIM platform yet, head over to learninvestmanage.com. Free access to all the tools, no payment required. You will also get an invite to our school community. Sign up and come find us there. Let's get into it. Let me start with a macro backdrop because it's going to set the table for everything else today. April CPI dropped this week. Headline inflation came in at 2.8 year over year. That's up from 2.4% in March. Sounds alarming. It's not. And here's why. The market consensus was 3.1%. We came in 30 basis points below that. RBC had forecasted 3.1%. CIBC came in the same ballpark. Both published same-day reaction notes. Both landed on the same conclusion. The Bank of Canada holds. Rate stays at 2.25%, and it will stay there throughout 2026. Here are the numbers that matter. Headline CPI at 2.8%, core inflation, the trim and median measures the Bank of Canada actually watches, averaged 2% to 2.1% year over year. CIBC ran an average of 4 core measures, and they dipped below 2% year over year for the first time since March 2021. That's a significant data point. The headline number is being driven almost entirely by energy. Gasoline was up 28.6% year over year, and that's not domestic inflation story. That's a straight up Hormuz story. There's an active Middle East conflict going on, driving an oil price shock, and strip out the gasoline entirely, and inflation actually decelerated 2% from 2.2% in March. The underlying Canadian economy is not generating broad-based inflation pressures. So what does this mean for Bank of Canada? Their overnight rate sits at 2.25%. Before this data dropped, markets were pricing in roughly 25 basis point hikes before the year end. CIBC pushed back hard on that. Their argument is worth understanding because it's directly relevant to how you model financing costs. Canada's output gap is negative. Unemployment is sitting at 6.9%. Real per capita household incomes are already declining before the oil spike even hit. Those are not the conditions in which a central bank hikes rates. The inflation risk, if there is one, is in the US, not in Canada. CIBC base case is both central banks on hold. The hike pricing is a tail risk scenario, not the base case. Here's what I'd be watching from an acquisition standpoint. 2.25% is your financing floor for 2026. Deals that need rate cuts to pencil don't pencil. That's the discipline the market needs right now. Stop underwriting to a forecast and start underwriting to actual cost of capital in front of you. One flag for the summer: CIBC noted that CPI readings will tick higher seasonally as airfare increases and higher transportation costs show up in June and July data. Don't misread that as inflation reigniting. It's a timing effect. The Bank of Canada will look through it. So here are your key takeaways. April headline CPI 2.8%, below 3.1% consensus. Core inflation 2 to 2.1%. CIBC measure average dip below 2% year over year for the first time since March 2021. So gasoline spiked 28.6%. Driving headline. Strip it out, inflation decelerated to 2%. Bank of Canada overnight lending rate at 2.25%. RBC and CIBC both forecast hold through the end of 2026. And market pricing in 2 hikes was tail risk, not the base case. This is per CIBC. Summer CPI will tick higher on airfares and transportation. It's more of a timing effect, not a structural shift. Something worth watching: oil prices. A prolonged Strait of Hormuz closure with triple-digit crude sustained through year-end is the single variable that changes the Bank of Canada's calculus. Watch crude as your leading indicator for any shifts in your rate posture. Next, we step into a condo bet. This is the most interesting capital move I've seen in Toronto market in a while. A Montreal-based family office, Gesta Group, 4 decades of experience across New York, London, Paris, and Miami, just made their first Toronto play. They closed a $30 million Burke condo acquisition in downtown Toronto, and they're targeting 1,000 units over the next 12 months. Total program, up to $500 million. Let me give you the context behind why they're moving when most people are running the other direction. So the market that they're buying into is historically distressed right now. GTA condo sales fell for a 35-year low in Q1 2026. 0 new condo projects launched in GTHA this quarter, first time in decades. Unsold completed condos inventory, 4,295 units as of Q1. That's double the inventory from a year ago and 5 times the level from 2024. These numbers are from Urban Nation. Gesta's thesis is that the oversupply is temporary. Their read, buy at a discount now, rent the units to service the debt, exit in 3 to 5 years when supply normalizes. And here's the supply cliff argument that underpins their whole thesis. GTA condo starts fell 88% from 2022 to 2025. A project launching today doesn't deliver until 2032. The 2028 to 2030 window has almost no new supply coming in. From my acquisition experience, what stands out about how Gesta is approaching this is the discipline of their criteria. High quality buildings by established developers only, no shoebox condos or dock rate condos, minimum 30 units available per transaction. Their first deal is steps from Toronto Metropolis University, transit access, walkability, a tenant profile that makes rental sense. These aren't distressed buys on marginal product. They're buying quality at distressed pricing. That distinction matters. The HST rebate is adding a meaningful catalyst here. New residential construction gets a 13% cost savings from a 12-month window from April 1st, 2026. So Gesta has urgency to execute within the year. Cushman & Wakefield is sourcing it for them. That's institutional infrastructure behind the program. Here's my honest read on the bear case. And Gesta named it themselves. Immigration stays suppressed. Population growth is near zero right now nationally. If that persists, the absorption of existing inventory slows and the recovery timeline stretches well past 5 years. That's not a fringe scenario. I'd also want to see some actual debt underwriting before I'm fully convinced the rental income services to financing at current condo rents, which are down about 2.6% year over year in Toronto. This article doesn't disclose any additional terms. So a couple of key takeaways. So Gesta Group, $30 million initial bulk acquisition in downtown Toronto, targeting 1,000 units or $500 million over the next 12 months. 4,295 unsold completed condos in Q1 2026, double the year prior and 5 times in 2024. That's per Urban Nation. You have 0 new GTHA projects launching in Q1 2026, and there's a supply cliff beginning to get locked in now. So as a strategy, they're looking to buy at a discount. They're renting to service the debt. Their exit is in 3 to 5 years and when supply normalizes. The HST rebate gives them a 13% cost advantage on purchases within 12 months. And that purchase window starts from April 1st, 2026. And their criteria is quality buildings, established developers, no shoe boxes, and 30 plus unit per transaction. Something worth watching, whether the rental income actually serves the debt at current Toronto condo rents. They're down 2.6% and still on the decline. The article says it works, but the underwriting math isn't disclosed. Watch for similar programs that do disclose the terms. So a quick pause. If you're getting value out of today's episode, the best thing you can do is head to learninvestmanage.com and sign up for the free access. Full tool suite, school community invite included, no payment required. Everything we talk about here on the show is designed to help you underwrite smarter. Learninvestmanage.com. The next story is about 75 Spencer. This story is an investor education piece. 75 Spencer Avenue in Parkdale, 72-unit mid-rise, sold May 4th for $15.5 million. That's roughly $215,000 a door, which is a cheap price. The catch, tenants have been withholding rent since March, and there's an active rent strike in place, active LTV eviction proceedings, and the new buyer just walked into all of that on day one. Let me explain what triggered the strike, because this is directly relevant to anyone acquiring Ontario multifamily right now. The former owner, Sumtai Ontario Inc., applied for an above-guideline rent increase in 2025. In Ontario, the annual rent guideline is capped at 2.5%, or was capped at 2.5%. Landlords can apply for a landlord and tenant board for an additional 3% if they undertake major capital work that benefits the tenant for at least 5 years. The former owner applied for an additional 2.9% on top of the 2.5%, which jumped, so a total jump of 5.4% in a single year. Tenants disputed the work, qualified. They stopped paying rent in March, and the building was sold in the 3rd month of that strike. One financial anomaly worth flagging. The mortgage on this deal was $15.8 million on a $15.5 million purchase, financing above the purchase price. The article doesn't explain, and I'm not going to speculate a reason, but that's not standard, and it's worth noting. One more data point. Sumtai bought this building back in 1983 for $1.45 million. They sold it in 2026 for $15.5 million. That's a 43-year hold. That's a long hold family ownership exit, and it's a signal I'm watching across Ontario's market right now. There's a lot of buildings that are at that inflection point. So here's what every buyer needs to understand. When you take a title on a building in Ontario, you take everything when it comes to it. The Aggie application doesn't reset at closing. The landlord and tenant board eviction proceedings don't disappear. The tenant organizing continues. All of it transfers with the deed. From my experience on the acquisition side, most buyers do the obvious checklist items, title search, rental review, environmental, but active landlord and tenant board applications, whether an Aggie application is filed, an eviction application in progress, or a tenant-initiated maintenance order, these need to be specifically surfaced and assessed before you close. They are not automatically disclosed. You have to ask for them. The Aggie mechanics are worth knowing cold if you're operating in Ontario. Guidelines in 2025 was 2.5%. Additional up to 3% is available for eligible capital work. The work has to benefit the tenant for 5 years or more. Lobby renovations are a weak basis for an Aggie. Tenants, in this case, disputed the benefit. If you're acquiring a building with a pending Aggie application, you need legal counsel to assess it before closing, not after. So key takeaways, 72 units sold in May 4th for 15.5 million, 215,000 a door. It's an attractive price. It's got an active rent strike in place, which might have affected the price. There was an Aggie, which is 2.5% guideline plus 2.9% for above guideline increase, which means 5.4% total 2025 rent increase, and which triggered a rent strike. Everything transfers at closing, Aggie applications, LTV proceedings, eviction filings, and tenant disputes. Due diligence must include active landlord and tenant board applications, pending Aggie applications or filings, your file tenant complaints, ask for them explicitly. And mortgage anomaly that we noted is 15.8 million loan on a $15.5 million purchase. It's very unusual, no explanation in the source. Also, it's a long hold family exit from 1983 at 1.45 to 2026 for $15.5 million. Legacy ownership is at an inflection point in Ontario. Something worth noting is whether the new owner drops the Aggie application as a path to resolution. Tenants have signaled that they will pay immediately if the Aggie is withdrawn. Watch the LTV docket for this property. Next, we have RentSafe TO. This one is imminent, June 15th. That's 21 days from today. RentSafe TO is rolling out a color-coded rating system for every apartment building in Toronto, green, yellow, or red, posted at the main entrance. And that's not just a sign. There are mandatory disclosures requirement attached to it. Here's how the scoring works. Green is 85% or higher, meets most of the city maintenance standards. Yellow is 70 to 84%, some violations, and red is below 70%, several violations. 2 consecutive months of red triggers targeted city engagement, including building audits. The city funded 73 bylaw enforcement officers in 2026 budget. This program has actual enforcement capacity behind it. The disclosure requirement is the piece that changes the operational equation for landlords. You must disclose your rating to prospective tenants before a lease is signed. You must disclose it after signing. You must disclose it annually to existing tenants. A red building does not have a compliance problem. It now has a leasing problem. That flows directly into vacancy, achievable rents, and ultimately your valuations. If I'm acquiring a Toronto building right now, RentSafe TO score is my due diligence checklist, not optional. And if I'm operating one, I want to know my score before June 15th, not after. The bear case on enforcement, 73 officers across hundreds of thousands of units in Toronto is thin coverage, but the disclosure obligation doesn't depend on officer presence. It sits with the landlord. That's where the compliance risk lives. So a couple of key takeaways. Launches June 15, 2026, color-coded rating at buildings, entrance, green at 85% plus, yellow at 70 to 84%, and red at under 70%. Mandatory disclosures, inform prospective tenants before lease signing, after signing, and annually. Red buildings, 2 consecutive months equals city audit trigger. 73 bylaw officers funded in 2026 budget. Red rating equals leasing problems, not just compliance problems. Direct impact on vacancy and achievable rents. And RentSafe TO score is now a required due diligence item for any Toronto multifamily acquisition. So something worth watching. First quarterly red building reports and whether the audit process creates forced remediation timelines that affect operations and cash flow. And whether red ratings begin showing up as explicit valuation discount in acquisition pricing. Last one, I want to close on this because it's a longer horizon signal, but one that I'm watching closely from an acquisition perspective. Ontario broke ground on the Bradford Bypass this week, 16.3 kilometers connecting Highway 400 in the west to Highway 404 in the east. Now officially designated Highway 425, west section construction is underway. The numbers behind the investor angle. Up to 35 minutes of travel time reduction between those two corridors. York Region population projected to reach 1.8 million by 2041. Simcoe County projected at 416,000 by 2031. Bradford East Gwillimbury, that's entire 400 to 404 corridor. These are already some of Ontario's fastest growing secondary markets. Here's what infrastructure does to rental demand. Better highway access makes the commute viable for GTA workers who couldn't justify the drive before. That expands the rental demand catchment for those markets. It's not just a traffic story, it's a demand story. I'd be watching 2 things specifically. Rental absorption in Bradford and East Gwillimbury over the next 24 months. And what happens at those interchange areas? Side Road 10, Country Road 4, the 400 connection. That's where land repricing happens first. Bear case, construction timeline slip. Government infrastructure projects delay, that's not cynicism, it's history. Population growth assumptions may slow, and the land in that corridor may already be pricing in the bypass upside if developers and holders have been anticipating this for years. Do your own current pricing analysis before you assume the trade is still open. So a couple of takeaways. Bradford Bypass, now Highway 425, 16.3 kilometers connecting Highway 400 to Highway 404, major construction underway, May 2026. Up to 35-minute commute reduction, improved GTA accessibility from Bradford and East Gwillimbury. York Region, 1.8 million population by 2041, Simcoe County, 416,000 by 2031. Rental demand signal, improved highway access expands tenant catchment for secondary market rental. And also watch for interchange areas at Side Road 10, County Road 4, and Highway 400 connection for early repricing. Something worth watching, whether current land and asset pricing already reflects the bypass upside, or whether 24-month window still offers value. Construction timeline risk is real. Verify project milestones before underwriting any demand assumptions. So let me pull the thread on everything we covered today. 3 themes I want to leave with you. Theme 1, the rate environment is stable but not improving. April CPI confirmed at 2.8% headline, core below 2%. Bank of Canada holds at 2.25 through 2026. If a deal doesn't work at today's cost of capital, it doesn't work. Build your model on reality, not on forecast. Theme number 2, institutional money is reading the supply cliff before retail does. Gesta's $500 million program is a direct bet that 2030 housing crunch is real, that today's oversupply gets absorbed before new supply arrives. That's the same supply cliff thesis that experienced operators have been watching building for the last 2 years. The window to position may be shorter than you think. And theme number 3, compliance and due diligence is not optional in Ontario multifamily in 2026. RentSafe TO launches in 21 days. Aggie dispute transfers with the deed. Landlord and tenant board proceedings. Follow the property, not the owner. Update your checklist. The regulatory environment has moved. So the episode takeaway. Bank of Canada's overnight lending rate, 2.25%, held through 2026, underwrite to today's cost of capital. April CPI, 2.8% headline, core below 2%, energy-driven spike, not structural inflation. Gesta's $500 million institutional capital repositioning for 2030 supply crunch, quality at distressed pricing. HST rebate offers a 13% cost advantage on new residential purchases, 12-month window from April 1st. 75 Spencer Avenue, Aggie disputes, landlord and tenant board proceedings, rent strikes, all transfer at closing. RentSafe TO, June 15th launch, color-coded rating with mandatory tenant disclosures. And then Bradford Bypass, York Simcoe corridor repricing signal. Watch rental absorption over the next 24 months. That's smart real estate for this week of May 20th. If you got value from today's episode, share it with one person in your network who's interested in investing in Ontario multifamily. That's how this community grows. And if you're not already on LIM platform, learninvestmanage.com, free access, full tool suite, school community invite included, no payment required. Everything we build is designed to help you underwrite smarter and invest with confidence. Underwrite smarter, invest with confidence. See you next week, Smarties. Addy Saeed is a licensed real estate broker of the Remax Gold Realty Inc., RICO licensed 4735346, founder and general manager of Westcliff Living and OSC registered dealing rep. Kaz Jaffrey is a CPA, CA, and OSC registered dealing rep. Ribu Ramprasad is a licensed mortgage agent, level 2 with BLD Financial, DLC license 12360. The host may reference companies or entities which they hold ownership or financial interest, including Westcliff Asset Management, Westcliff Living, Olympus Properties Management, Finalized LLP, and others. Listeners should be aware of these relationships when evaluating any commentary in this episode. Podcast is for informational educational purposes only. Nothing in this episode constitutes financial, legal, mortgage, or investment advice. Always conduct your own due diligence and consult qualified professionals before making any investment decision. Past performance is not indicative of future results.